Hello, good morning, everybody. Thank you so much for joining me today. I know we have a lot of good information to cover. It is going to maybe seem a little bit overwhelming because we have a lot of changes to the Part D prescription drug plans this year. So I'm really excited to dive into it with you. So thank you so much for joining me. If I didn't say it, I'm Christy Wilbert, Senior Vice President of the Medicare Offerings Department at URL Insurance Group. And we are just going to start out walking around the screen really quick before we jump into everything. I have so many good handouts here for you today. So on the top right of your screen, you're going to see a handouts button. It's the furthest to the right. Go ahead and click on that. You are going to see a bunch of CMS handouts. You're going to see a link to an article. There's some great stuff there for you if you really want to get into the weeds of all the changes that have been going on right from CMS. There's a lot of bad information out there from people misinterpreting what's out there. So please make sure that if you are working with URL, you are turning to us for that information and that education, and you're not misled by other things on the internet or Facebook groups or anything like that. Because I see them too, I read them too, and I know it's out there personally. There is a spot for question and answer as well. Please make sure your questions go in there. If you have a chat, if you want to mention anything, go ahead and put that in the chat box. And you open all that by pushing the blue chat box on the bottom right of your screen. All right, so let's go ahead and get started. I think the best way to start is just to give a little bit of history of Medicare in the Part D world. Years ago, before 2003, there was no drug coverage. People were paying out of pocket for their prescription drugs. So what happened is in 2003, the Medicare Modernization Act was developed by the government. So the federal government came in and said, we're going to subsidize prescription drugs so that everybody can take their medication and lead to a healthier lifestyle, keep people, with lower incomes being able to take their medications, because people were just skipping them because they couldn't afford it, which is still happening today. And that is why the government is so involved in the drug portion of our program. Where did we start as agents? I remember I came to URL 10 years ago, and what we were doing was quoting on Medicare Plan Finder on Medicare.gov. You had to put every drug in. There was a limit of 25. You were saving the little code they were giving you per person, and the date was the password to get back into it when you had to. And if you didn't save that information, you lost it forever. So you had to start over and quote them again. It was a really hectic and terrible operation that we all had to go through to sell a prescription drug plan. So not many of you were doing it. A lot of you were having your clients self-enroll on Medicare.gov. Maybe you were just quoting and advising and telling them, call the carrier directly. This is the plan that I recommend that you enroll into. So you're doing your clients that service, but you weren't really worried about the commission because it was a lot of work and a lot of maintenance. I feel like that has changed progressively for sure now, where more of you are taking on that Part D enrollment and helping the clients every year on the annual enrollment period with their Part D, because it is very confusing and it is something that needs to be reviewed every year. So it has become very time consuming. Definitely a lot of movement in the Part D world. Carriers have come, carriers have gone. We get really excited when they've pulled out the commissions on the Part D and then they bring it back. We're happy about that, but we have seen a lot of turnover on the Part D side of things, not only from the standalone Part D carriers, but even the big ones that have, Medicare Advantage plans and Part Ds. They're pulling out of the market, or they've sold to a different organization and then started over from scratch. So it's been quite the whirlwind, and we're here to go through it all with you. They're giving us no break this year, I'm sure, with all of that. So what are we seeing in the marketplace is vertical consolidation. So what does that mean is that, everybody's kind of joining forces. There are some pros to that and there are some cons to that, just like everything else. But we're seeing a lot of acquisitions of retail pharmacies. And who is acquiring them is your pharmacy benefit manager. So the people that are out there supposed to be negotiating drug prices for you, like your Caremark, for example, they're buying pharmacies. They bought CVS. What are some other big ones? Express Scripts, Optum. So they're all buying pharmacies, which makes it really interesting because it's like they shouldn't be in the pharmacy owning business. It seems like it should be against the law or something for them to own pharmacies, but it's something that we're coming across more and more. Integration with insurers. Unfortunately, the Medicare carriers are buying up organizations like that as well, the pharmacies. We see that with Aetna and CVS, they're in cahoots. And there's more of them. That was just an example. Rite Aid had Envision, which is no longer in the marketplace. But that directly influences drug pricing and the formulary placement. So there's definitely a conflict of interest there. And then, what the Inflation Reduction Act is doing this year is really focusing on the specialty drugs, trying to drive that price down because they're huge costs to the beneficiaries. And we're seeing that has to go out to, the specialty drug market, and carriers now own their own. They're not going out and using A, B, and C anymore. They're using their internal structure, which also seems like a conflict of interest. So drug rebates, I do want to touch on really quick. Again, with the pharmacy benefit managers, they're the ones that are out negotiating prices with the manufacturers. And what they are doing is they're supposed to be sharing their rebates. So when somebody buys an expensive drug, let's just say, for example, they're getting 40% back in their pocket from that expense. It's supposed to go back in the pockets for the consumers, so they're not spending a ton of money, which isn't happening. So what CMS is trying to do is forcing these people to put that money back into the plan so that they're not as expensive. We'll see if it happens. It's not shared now. I don't know. The pharmacy loses money every time that they're filling a brand name drug because of those rebates. So they have to fill, tons and tons of generic medications to even make any money at the pharmacy level. It's all your big, manufacturers that are making their money. Okay, so the Inflation Reduction Act, it's also known right now as the prescription drug law. And I'm going to try to not get too political on you, even though there are a lot of politics involved in this right now, especially since we're on an election year. But I just want to stick to the facts and what's going on. So basically, they're trying to make several improvements to the basic Medicare D drug benefit. Okay, and we are going to talk about the difference here in a little bit. But they are projecting to save people with Medicare an average of 30% in your annual out-of-pocket prescription drug costs in 2025, which is huge. This will result in a decrease of approximately $7.4 billion in out-of-pocket prescription drug spending for people in Medicare. So I really hope that it does that. The goal is always to save money for the consumer, right? They're the ones at the end of the day that are really hurting here on the drug costs, and they're taking more and more drugs. All right, so this started in 2022. In 2023, we all saw that the vaccines were covered. Shingles, the single shot used to be a tier 3. Now it's a $0 copay. We had the insulin savings program, where they maxed the out-of-pocket costs at $35 copay, which has been fantastic. Some have even been less than that. This year, for 2024, we had the catastrophic phase for the enrollee go down to $0, where before you were paying, 5% of the costs, and that was transitioned over to the carrier, which has been fantastic. So it's only improving more for 2025. For 2025, there's going to be a $2,000 annual out-of-pocket max. So what they're hoping that is going to happen here is that overall, the changes of how the government subsidizes the Part D plans is they're shifting from largely being consolidated on the back end based on of like beneficiary costs and reinsurance payments, that it's going to move the risk adjustment subsidy payment up front. So by design, the plans will have more liability, requiring them to better manage costs within the upfront payment amount. So that's the goal. Hopefully we see that happen. Not a lot of plans have come out with benefit information that I can tell you, I've seen it all right now. Usually in those carrier certifications that we do here internally, so that we know what you're seeing, and the carriers usually go over their new benefits for the new year with us. I would have seen them all by now, and I have not. To be honest with you, I have only seen what's in the carrier certifications. So I've saw, WellCare came out with some benefit information on their PDPs, which looked pretty standard, which is great. There's still some tiers that do not apply to the deductible. There's still co-payments. There's still co-insurance that seem pretty straightforward. I'd be interested to see how this affects the formulary and premium. There's no premiums out there yet, if you've noticed. So anyway, the gap is going to be gone. There is a new discount program which requires manufacturers to provide discounts on drugs in the initial and catastrophic phases. This is where they're trying to get that rebate back into the pocket of the plan design. And cost sharing changes among the enrollees, plans, manufacturers, and CMS, which we're going to go over a nice little graph that I have for you so you can visualize it better. And they did expand the eligibility for the extra help program. So obviously people can still enroll in extra help, LIS, PACE, and all those, because that is going to help you more in your out-of-pocket costs than the Inflation Reduction Act is going to. Okay, let me just make this bigger so I can see it. And I think you have the opportunity to do that too if you need to make it larger. And I have these slides available if you would like them after the fact. I'd be happy to email them to you. We are recording this today as well, so you can go back and watch it later if you want to. So what this is showing is a side-by-side of the last 2 years and then what the future is for 2025. What I want you to pay attention to is, well, looking at 2023 versus 2024, you'll see they look very similar into the catastrophic coverage. And that's where we talked about in 2024 on the last slide, the enrollee took back that 5% and that was passed on to the plan. So that shows there at the very top. If you look over at 2025, starting at the bottom, we have the deductible phase, which every plan will have a deductible. Some haven't in the past, so we'll see how that still applies. And then in your initial coverage period, before the carrier was paying 75% and you, the beneficiary, your client, was paying 25%. So that is still almost happening. So what's happening is the plan's going to pay 65%, the drug manufacturer is going to pay 10%, and the enrollee is still going to only be responsible for that 25%. So that's where, when you look at the plan designs, we shouldn't be seeing too much difference in those copays and coinsurance in the initial coverage period, because it still is only at that 25%. Then if you see after the $2,000 is hit, there's no more enrollee charge. It's all split up between Medicare, the drug manufacturers, and the Part D plans. So Part D is paying 60, where before they were paying 20. So that is a huge burden on the Part D carriers. And that's why we're believing that we're going to see a premium increase for all of these plans. 20% on the drug manufacturers, 20% on Medicare. So they're splitting at 50-50, the majority, what's left after that. So what is something that we should look at here is before, like this year and in 2023, the plan really had a benefit in pushing the client into the donut hole, right? Because they wanted to not have to participate, where they are participating in the initial coverage period for those years, and only very, very little in the donut hole. Well, now it's the complete opposite. the carrier is paying a lot after we hit that $2,000 mark. So they kind of want to keep us below that. Their goal would be to keep us in that initial coverage period because they're paying, we're still contributing in that phase. So I think that's important to see. Okay, so just some upcoming predictions, and we kind of went over this already, but there's no motivation to get enrollees into catastrophic, as we saw on the graph. Increased amounts of step therapy to keep people on low-cost drugs. I mean, that's what step therapy is all about, right? It's to keep you on like a generic drug, not have you go to brand name, because they're more costly for everybody. And the only people that make money on brand name drugs are the manufacturers with their rebates. So they want to keep you on a generic. If you go past your $2,000, why not take the brand name drug? You don't pay anything anymore. So there is definitely going to be some step therapy. Formulary restrictions. The government's trying to force the pharmacy benefit administrators to share their rebate. They won't, which we discovered. Different drug options in the same drug class. I think that's really important. You don't have to be, a pharmacy specialist and a drug specialist here, but it is important to know options for your clients. Like the WellCare 50-cent plan this year, it did have 2 insulins on it that just aren't very common names. So a lot of people were like passing on that plan because it didn't cover insulin. It did, just not the ones that we're used to hearing. So having a person be more flexible on the prescription that they're taking or having a conversation with their doctor might need to happen if these formularies start to become a little thinner with these new drug plans, because the higher rebate drugs might not be listed. All right, so we are expecting some higher premiums. I do not have a slide for this, but I feel like it will be good for us to go over it now because it makes sense. CMS did release a new article yesterday, and of course it was last night, so I didn't have time to make some slides, but I do want to cover some of this information. We did post it on our social media page. If it's not already there, it will be posted today, so you can read it in its entirety. But it's talking about the premium stabilization demonstration for Part D premiums. So what is this? Okay, really what they want to do is try to keep the costs of the premiums down. And we want everybody to be working together to be able to do this. So what they're saying the base premium is going to be is $36.78, which is $2.08 more than what it is right now in 2024. So remember, this is like the average base pay premium. There's a difference between a base premium and a supplemental premium, and it's the two combined that create the premium for the standalone drug plans. So your base premium is just your standard drug coverage, including the formulary. Your supplemental premium in that is your enhanced coverage, like the lower co-payments, a wider range of medications on the formulary, and some other added benefits. So you could have a low premium plan that is just the basic premium, or you can have a higher premium standalone prescription drug plan that includes some lower co-payments, a wider range of medications on the formulary, and that sort of thing. So when they're talking about this $2 max per month that they're going to allow the increase on, it's on the base pay. So that doesn't mean it's in total. That's just the base. Okay. So you can see more than that happening. But basically, this demonstration, it is going to be kind of, first of all, voluntary. Okay. And it's going to give meaningful protection offered to consumers. So it's structured to encourage all standalone Part D sponsors offering drug plans to participate to provide stability across the entire Part D market. Voluntary, as we said, if you go in year 1, you're eligible to do it the next 2 years. So it's a 3-year like trial, let's say, that they're going to see how it works. If the Medicare carrier does not participate this year, 2025 upcoming, they're not able to jump in the next 2 years. So they're kind of opting out for the whole experiment, let's say, or demonstration. They use that word. So it consists of 3 elements, this demonstration. First, CMS will apply a uniform reduction of $15 to the base premium, which we talked about before. So if the base premium of a plan, which you don't know what it is, this is on the carrier side of things. So if a plan is $25, let's just assume 15 of it is base pay and $10 of it is supplemental. We don't know. We don't see that breakdown. But for this example, if the negative $15 takes the base pay to anything below 0, it's just going to end at 0. Okay, that's the base pay. So they can still charge supplemental, remember. And then the second target for CMS in this experiment is a year-over-year increase limit of $35 for the total premium. So what that means is that we shouldn't see anything come up higher than $35 for a total premium, which is great. It's nice to have the max on there. And then the third element of the demonstration will be a change to the risk coordinators to provide for greater government risk sharing for potential plan losses, which is great. They're going to kick in some more benefits for us. So since this is voluntary, by the way, the carriers, this started yesterday, they have until 8/5 to opt in or out of this. And why would a carrier want to join? It's because there's financial risk. And this is going to give them some more stability to attract new enrollees, right? It's a huge marketable potential. You're showing commitment to the cause. You're trying to improve the drug coverage for beneficiaries. You're trying to keep premium down. So it's definitely going to put you in a good market, space. And then potential for risk sharing from the government, which will enhance benefit options. It's going to give you some more money to be able to give all those supplemental coverages that everybody needs in their drug plan. Why would the carrier not do it? So financial risk. So they're kind of the same on the pros and cons. Are they going to depend on the government to risk share, to spend that money to share the rebate? There's also a lot of administrative burden. I don't know if you've read the whole final rule, but CMS has put a lot back on the carrier administratively this year, on top of trying to get rid of the FMOs. I don't know how they were going to do everything. If you've been following along, there is a stay. So the FMOs are protected until litigation begins in January after our new president's in office. So we'll see what's going to happen there. But they are tasked with a lot of new things that they have to do for the beneficiary on education and letting them know of the benefits that they have in place. Plus, we're going to get into some prescription drug things that they have to do as well. So to have this on top of it, it's just a lot at once. They definitely weren't messing around this year. So because it's so much, I could see the Medicare carriers coming back and being like, we don't even have the staff or the manpower or the ability to do this right now. It's too big of an administrative burden, but we'll see. And then maybe they already have a strong market position and they have different goals in place that seem better than what this program is going to offer for the enrollees. Who knows? So definitely some pros and cons to this. Like I said, we have it on our social media page if you want to go out and read the whole thing. All right, so sorry to jump off the slide there and go off on a tangent, but I thought it was important to go over that article because, again, it is out there and it is hot news and topics right now. So upcoming predictions continued. We do think there's going to be fewer plan choices. There are going to be some plans out there that are probably non-commissionable. Who knows? We will find out here shortly, hopefully by our conference, which if you haven't registered, that's on August 22nd at the Hershey Lodge, and you can register on our website. And we do think that more beneficiaries are going to be moving to Medicare Advantage plans simply because typically the formularies are larger. The MAPDs do get rebates as well, and they're able to absorb a lot of the basic Part D costs within the plan design, which makes for lower cost sharing for the beneficiary. And then the cost of an MAPD is a lot less than your standalone drug plan and MedSup. So it just keeps your budget lower. We have heard a lot about this recently, so I just wanted to touch on the impact to credible coverage. So obviously this is a thing now already. When group carriers have to design their plans for their people that are working, they have to design it and then also figure out if it's credible coverage for Medicare. So what that means is the coverage just as good or better than Medicare? So when somebody transitions off the group, is Medicare going to determine it as credible? So they always do the math on their side. I had a conversation with Capital Blue Cross, for example, since they do individual group and Medicare, and asked how is this going to change for them? And they said, it's really not. They're going to do the same calculations that they've always done, which is the simplified determination. And basically they do it per plan. So the PPO, the HMO, the HSA, the high deductible plan, and they let you know through calculations if it's going to be just as credible as Medicare or not. They always have plans that do not reach that minimal credible coverage, and they have ones that are. Same thing's going to occur. There might just be some additional plans that aren't credible. So what you want to do is just be in touch with your group provider on the plans that you're writing the groups on, and they'll let you know if it's credible or not for Medicare. But they do, expect the group coverage to tell the groups, way ahead of time before October 15th. The plans have to let CMS know if they're going to be credible or not, so that it is in the MARC system. And they have to disclose to CMS, 60 days after the start of each year. Employers should ask their carriers if all the plans offered are credible, which we said that each one is evaluated separately. And then self-insured plans should use the simplified or actuary determination method, which that's just, deciding if somebody picks up their drugs for the year, if it matches or betters what Medicare has out there. Just for your information, this is not really enforced, the credible coverage, because employers are not penalized for offering non-credible prescription drug coverage. Like we mentioned before, that happens currently. So this isn't new information. Employers are responsible for communicating to their employees if coverage is credible or not. Medicare eligible individuals can be subject to penalty. So if you are on your group health plan and you continue to work past the age of 65, making you eligible for Medicare, and you do not enroll in Medicare, you stay on the group that's not credible, you will get a penalty when you enroll into Medicare later and you come off the plan when you retire. If you have any questions about that, you can contact Thomas Purcell or Elise Fry here at URL that run our group division, and they'd be happy to go over it in more detail with you. I just wanted to mention this, that the group health plans do have an opportunity to enroll what's called retiree drug subsidy. And this is under Medicare that enables employers and unions to continue assisting their Medicare eligible retirees, which makes for more generous drug coverage, which is great. So if you didn't know that exists, it does. All right, so this is a new thing for this year too, and I had to do a lot of Googling and ChatGPT questioning for this. So I just wanted to make sure that I was passing along the education that I found out there. There is a nice little handout of frequently asked questions that I put in there for you. So I would recommend that you download that. But for the first time, beginning in 2025, the Drug Law or Inflation Reduction Act is requiring all Medicare's prescription drug plans and Medicare Advantage prescription drug plans that has it in it to offer enrollees the option to pay out-of-pocket prescription drug costs to pay it monthly. So this will come in the form of capped monthly installment payments instead of all at once at the pharmacy. So how's this going to work, right? That's what we want to know. So I've heard carriers call this M3P. So I'm going to pass that along to you. And the program really is that when the person goes up and picks up their prescriptions, they're going to pay $0 to the pharmacy if they opt into this program. Okay. And then the carrier is actually going to bill the participants monthly for any cost sharing that they'll have up to that $2,000 out of pocket. I'm just going to make this bigger. So here is an example, and I did attach the CMS guidance of what was given to the carrier plans. So if a person goes to the pharmacy in January and maybe they are picking up a drug that's on tier 1 and they just have the $4 copayment, they're going to go ahead and pay that. Okay. Then they go in month 2 and they have a biologic drug that's a specialty pharmacy, let's say, and has a co-insurance of 40%. So they have this huge cost, right, up to the $2,000 out of pocket. So what if they opt into this program? They can divide the monthly payments out for the rest of the year, and that's what they will be billed by the insurance carrier, not pay at the pharmacy. So that's pretty nice. There's other examples out there for you if you need some more. Excuse me. Okay. So prior to the plan year, the Part D sponsors, which is the carriers, are required to assess their current Part D enrollees and kind of determine out of their enrollees who is going to reach that $2,000 max out-of-pocket cap and who should be told about this program in advance so that they can sign up and not have to have like a oh no issue at the pharmacy where they're not enrolled. We're going to try to get out in front of it, not have people, have sticker shock value when they go to the pharmacy and not have a good experience. This was something I thought about instantly, so I wanted to share it with you. For M3P termination, if a participant, since the carrier is going to be the one invoicing for this to the plan member, I was scared if the plan member, the beneficiary, wasn't paying their drug costs, that they could actually get kicked off their drug plan. But that is not the case, as you'll see here. So the participation in the program will be terminated following a required 2-month grace period. Importantly, the Part D drug plan sponsor, which the carrier, is not permitted to terminate the individual's enrollment into the Part D plan, just the payment program. So I thought that was really important to pass along. So signing up. The person can sign up, opt in into the program prior to the beginning of the plan year or any month during the plan year. So if they don't opt in January in the beginning of the plan and, they're fine because they're in the deductible phase, and then come initial coverage period, they have a big cost, they can call their Part D plan and enroll at that time. Okay, as you'll see here, the sponsor, the carrier, has 10 calendar days in the beginning of the year to get them on the program. But if they jump in the middle of the year, they have 24 hours to process it so people can pick up their prescriptions. Fingers crossed for carriers that they can get that done in that timely manner. I think that answers your question, Joanne, that you had there. Okay, I know that was a lot of information. Let me see. I think I have some questions here. This customer service will act thereof. Will it change to domestic based on customer service reps? Seniors do not understand them clearly. No, Mike. Nope. A lot of the carriers outsource their their customer service, unfortunately, and their producer help desks. That all has to do with, staffing, and another great reason why they shouldn't get rid of the FMOs. If you ever have questions, you can call us and we'll try to get you a more efficient answer in a faster amount of time for you. Will this be a question on the application? Oh, good question, Avi. I have no idea. I have not seen a 2025 application as of yet. Sean, yes, you can have a copy of the presentation. I believe we can all agree on premium increases, but do you not think that we may also see tiers to increase, maximizing the average $2,000 all across the board helping? Joe, no. And I did explain that on the slide showing 2023, 2024, 2025. I believe they're going to try to keep us in the initial coverage period as long as possible because that makes sense for the plan. The plan is going to pay a lot more after the $2,000 cap, which means they'll want to keep the tiers low, deductibles not applying, and I have seen coverage with a few of the carriers that they look business as usual, just have not seen premiums yet. All right, well, if you have any additional questions, I'll be here all day and happy to answer them for you. Thank you so much for joining me. I hope you found value and got some good education out of this today, and appreciate you joining me. Have a good day.